Hi everyone, Brittany here with Finder.com. Today, we're taking a look at how mortgages work. Buying a home takes a solid chunk of time, but breaking it down into easy to handle steps can make it a lot less intimidating. So let's begin with the basics. To start off, what is a mortgage? A mortgage is a way to finance the purchase of a property. It can be your primary home, a vacation home, or even an investment property. The mortgage is secured using the property you're buying as collateral. Defaulting on it means risking your home. The lender can repossess it to recoup its losses. No matter the type of mortgage, it's essentially split into two pieces. The first is the principal, or the amount that you borrow. The second is interest, which the lender charges on top of the principal each month. But the way interest is applied and how it affects your payments varies on the type of mortgage you take out. There are two basic types of mortgage rates, fixed and adjustable. The types of rates refer to how interest is applied. Fixed rate mortgages have an interest rate that stays the same throughout the life of the loan. It means monthly repayments don't change over the life of the loan and allows for easy budgeting. Adjustable rate mortgages, or ARMs, on the other hand, have interest rates that change with the current lending market. Since the interest rate can go up or down, so can your monthly payments. And with rates at historic lows, you may see more increases than not as the market shifts over time. You may also be able to get a third type, a hybrid ARM. It starts with a fixed rate period and then has an adjustable rate after a set amount of time. Usually, the fixed rate term is between 5 and 10 years. Let's take a quick look at a simplified example of just how much each costs. A $300,000 fixed rate mortgage with a 3.8% interest rate and a 30-year term would have a total cost of about $503,000, but the monthly payments would only be about $1,400 a month. An adjustable rate with the same starting rate, term, and amount can end up with a much different payment over time. A 5/1 ARM that can change by just 0.25% at a time and is capped at 12% can still reach a maximum monthly payment of almost $2,000 and a total cost of more than $615,000. Of course, these examples do not include any additional costs that may be included in your monthly payment, such as property taxes or home insurance. There are also different types of mortgages. Let's start with conventional and government insured. Conventional mortgages don't come with any kind of outside support for the borrower's credit worthiness. This means you'll generally need, at bare minimum, a good credit score of at least 620 and a down payment of between 3 and 20%. Government insured loans come with a bit of support, which means you don't need to have perfect credit or as high of a down payment. The government guarantees part or all of the loan, which makes lenders more willing to accept borrowers who may not meet their normal credit standards. Different types of government programs have different requirements. The Federal Housing Administration backs FHA loans. FHA loans can help those with lower incomes and are popular with first-time home buyers. Typically, credit scores as low as 500 are accepted, and required down payments of either 3.5% or 10% depending on your credit. For military families, the Department of Veterans Affairs offers VA mortgages. These come with the ability to skip mortgage insurance and down payment if needed. Rates can be lower than conventional mortgages, and you won't face prepayment penalties either. To qualify, you'll need to be an active duty service member, veteran, or surviving spouse. The last of the government-insured mortgages comes from the U.S. Department of Agriculture, which insures USDA mortgages. The property must be within an eligible location, and your household income must be within 115% of the median income for the area. These loans tend to come with lower rates than conventional mortgages, no insurance requirements, and the ability to pay little or even nothing down. Interest, mortgage insurance, and a down payment aren't the only cost you have to deal with, so let's cover one last topic: mortgage fees. Your exact closing costs may vary depending on your lender, but there are typical fees you can expect to pay. Set fees that don't change with your loan amount include a credit report fee, which ranges from $30 to $40, gives your lender an idea of how risky you are as a borrower. An appraisal fee, which runs between $300 and $500, is an assessment of what the property you want to purchase is worth. Inspection fees cost between $200 and $400 and go toward making sure there are no hidden defects in the home. A survey fee runs around $350 and is required in some states to make sure property lines and boundaries are correct. Title search fees run from $75 to $100 and prove that the seller has the right to sell the property. Title insurance fees are heftier, ranging from $1,000 to $5,000 and can protect both the buyer and the seller. Homeowners insurance, which can range from $300 to more than $3,000 a year, can usually be paid in yearly or monthly installments. This means set fees can range from just shy of $2,300 on the low end to more than $9,400 on the high end. There are also some fees that depend on your loan amount, including an origination fee, or the administration fee for processing your application, which ranges from 0.5 to 1% of the amount you're borrowing. A closing fee, which goes to the attorney or company that handles your mortgage closing, ranges from 2% to 5% of the loan. Another fee you may encounter is private mortgage insurance. Different than homeowners insurance, it's usually required if you put down less than 20% of the purchase price and ranges from 0.3 to 1.2% of the loan amount. The last fee is called a point. While not required, you can pay a point, which costs 1% of the loan amount or a number of points in exchange for a lower interest rate. This adds another 2.8 to 7.2% in fees, not including any points you purchase. Now that you know the basics, you can start your search for the perfect mortgage to match your dream home. To get more information about how to compare your options, check out Finder.com for guides on each mortgage type and reviews to help you narrow down lenders. Just check the description for the link. Check back for even more tips to make financial decisions even easier. And don't forget to hit that thumbs up and give us a like, and click the bell to get notified when new content goes up. Happy house hunting!